Welcome to this explainer. Today we're intentionally stepping away from the daily price noise, the endless market chatter, and all that short-term sentiment that just distracts so many people. Instead, we are going to look at this protocol's structural mechanics purely from a builder's perspective. We want to really understand the engine under the hood here. Specifically, we're going to explore the convergence math of PLAZM and why one very specific number on your dashboard completely changes how you should view the protocol's floor. Okay, let's dive right into this. Look at this ultimate dashboard receipt. This is the claimed profits counter as of day 213, sitting at exactly $130,337.42. Now, most people, they just look right past this number to stare at the token price or maybe the total vault size. But honestly, from a systems engineering standpoint, this is absolutely the most important data set you have. Why? Well, because this is not theoretical money. It's not some loose promise of future yields, and it's definitely not capital just sitting idle in a reserve somewhere. This is the cumulative dollar amount that has already been deployed by the protocol. It's literally the receipt of execution. And to really grasp the impact of that deployed capital, we have to frame this entirely within the 77-day staking cycle. If you're a builder, a cycle is the natural unit of measurement for this protocol. It's not a calendar week, and it's certainly not a 24-hour chart. The engine is designed to run day in and day out across these 77 days. Contributions flow in, the vault accrues value, and the deployment engine runs every single day without fail. Right now, we're at about day 60 of cycle 3. So the right question isn't what happened yesterday, it's what compounding force has been built over the course of this entire cycle. So here's our roadmap for tearing down the system that produced this receipt. We'll start by deconstructing deployed capital. Then we'll look at the 65-10-20 blueprint, dive into the convergence math, discuss decoupling from fear, and wrap up with your cycle watch list.
All right, Section 1, deconstructing deployed capital. Let's reconcile exactly where that 130K receipt went.
This perfectly audits the deployed realities across the protocol's 3 operational lanes. Let's break it down because it's fascinating. The buy and burn lane has deployed over $79,000 over its lifetime. That is literally buying tokens and removing them from circulation forever. Then you have the buy and build lane, which has deployed $29,540, deepening the liquidity pool so the order book is thicker on both sides. And if you add those up, well, you're left with a residual of roughly $21,600. So where is that? It's sitting right there in the buy and grow lane. It's been compounded back into purchasing more bonds. That residual is buried inside today's count of over 13,000 bonds. It's literally the protocol paying itself. Moving right along to Section 2, the 65-10-20 blueprint. This is all about how that yield split is engineered. Notice how the daily yield, which, by the way, sits at about $286 today, routes incredibly deliberately through the protocol. Look at that massive 65% slice dedicated to buy and burn. Why does permanent supply removal completely dominate this chart? Because structurally speaking, it's the single most powerful long-term lever you can pull in a protocol. Burns cannot be undone. Meanwhile, buy and build only needs a 10% slice because realistically, liquidity pools just require incremental top-ups to stay super healthy. But the absolutely crucial point here is that 20% slice going to buy and grow, and what it guarantees. This is a self-purchasing mechanism. It ensures that the treasury just keeps growing and compounding, even if, say, not a single new user arrives today. It doesn't rely on hype, it doesn't need fresh external liquidity, it just quietly compounds real yield into a larger treasury position day after day. Which brings us to the real meat of this explainer in Section 3, convergence math. This is where we cross the structural threshold. Now, if you take absolutely nothing else away from this explainer, please understand this definition. Convergence is the specific threshold where the daily dollar value of new token emissions falls completely below the daily dollar value of the buy and burn deployment. It's the fundamental equation that dictates exactly when a price floor becomes structurally locked. And keep in mind, the buy and burn deployment is fueled by real yield USDC generated from the protocol's margin strategy. So this isn't speculative capital, it's hard yield actively eating away at the emission schedule. Let's look at today's actual hard math. On the left side, we have today's release, 13,336 tokens at the current price, which equals roughly $160 of new sell-side emission pressure. Okay, now look at the right side. We have today's buy and burn deployment, which again is 65% of our daily yield, sitting at approximately $186 of relentless buy-side pressure. Just look at those numbers. The right side is bigger. We literally have $186 aggressively eating $160 of emissions. The inequality has officially flipped.
But actually, we have to remember something really important. Convergence is a threshold. It's not a one-time event. You don't just cross it one day, wave a little flag, and walk away. Because token emissions naturally decay at negative 0.08% per day, this threshold simply tightens, day by day. Every single day, the math gets slightly more aggressive in favor of the buy and burn. And that's exactly why the claimed profits counter is so vital. It's an undeniable audit trail proving this engine runs consistently, constantly pushing against that threshold. Let's move to Section 4, decoupling from fear. Let's stress test these mechanics a bit.
Now you might be thinking, the math looks great on paper, but what happens when everyone is terrified? Let's look at the reality. Recently, the broader crypto fear and greed index dropped all the way down to 29. That is deep into fear territory. New entries slowed down, trading got super light. And hey, that's a real psychological effect. But look at the other side. During that exact same period of fear, the protocol's vault actually gained ETH, pushing up to nearly 210 ETH, even with people panicking. The vault still accrues, the bonds still pay yield, and the margin strategy just continues to execute. So, the crucial takeaway here is this. The protocol's floor mechanics are completely decoupled from macro sentiment. Fear simply does not stop the convergence equation from running. And this decoupling, it isn't an accident, it is a highly engineered design feature. The system runs on user contributions and yield strategies, which basically means the math simply doesn't care if a trader is feeling fearful today. The burn is going to continue regardless.
Finally, Section 5, the cycle watch list. Let's look ahead to that day 77 boundary. As we approach the end of Cycle 3 over the next 17 days, I want you to ignore the daily charts. Instead, watch these 3 specific metrics on your checklist. First, the burn count slope. We are currently at 19% of the total supply burned. Watch that line steepen. Second, the claimed profits run rate. We just crossed 130,000, and at current yields, it's targeting the 135 to 140,000 window by the cycle boundary. And third, the vault ETH delta. Watch the vault continue to add ETH. If you see these 3 metrics trending upward straight through a fear regime, it proves, without a doubt, that the convergence thesis is a structural reality, not just some nice narrative.
I'll leave you to consider this final thought. When you evaluate a protocol, are you getting distracted by the daily noise? Are you actually tracking the undeniable audit trail of deployed capital? The math here is executing relentlessly. The threshold is tightening as we speak. So the only question left is, what exactly happens to the market dynamics when the broader public finally wakes up and realizes this convergence has already happened? Keep your eyes on that threshold, and I'll see you at the cycle boundary.